Hi everybody, and welcome to our week 9 video. This week we are going to be covering two different chapters, and it is about budgeting both on a master budget level and on a flexible budget level. So let's get going with this. The basic idea of budgeting. This is all about planning, and we're going to focus a lot on planning and controlling as the highlights this week. So, a budget is a detailed quantitative plan for acquiring and using financial and other resources over a specified time period. Okay, so we call this budgeting, and using the budgets as a control measure, which we will see a little bit later in this lecture, is also known as budgetary control. Okay, simple enough. Some of the advantages of budgeting is it communicates plans to a team. It helps define goals and objectives. It allows both management and other people in the company to think about and plan for the future. It helps allocate resources and coordinate activities. And it also uncovers potential bottlenecks or places where you can get stuck in the process because you don't have enough machine or whatever to push through the what you're planning to do. Okay. So, budgets are prepared for reasons other than projecting income statement and balance sheet account balances. Think about some other information that you might see on a budget, such as the need for short term borrowing or estimating raw materials needs. A topic I want you to consider as we do this is something called responsibility accounting. Okay, and this is a concept that managers should only be held accountable for that over which they have direct control. Uh, so this is why when we've talked about contribution margin and some of the other topics we've discussed in the past, the whole idea of variable costing versus full costing, we've kind of been alluding little by little to the idea of responsibility accounting. Remember, under variable costing, we didn't consider the fixed overhead costs. And that's because, in a large part, the managers do not have control over that. The depreciation, the rent, the different factory or company overhead. And so, responsibility accounting enables organizations to react quickly to deviations and to learn from the feedback that they get. So the first step in this is choosing your budget period. Operating budgets generally are a 1 year period, and that's also when you look at financial statements, and I know we haven't gone into this much because that's more of a financial accounting topic. Operating budgets are 1 year, and on financial statements, you'll see current versus long term. And the difference between those two, current is within a year, long term is generally greater than 1 year. So just to put this in perspective for you. Many companies divide their annual budget into 4 quarters, and you'll see that very commonly. A continuous budget is a 12-month budget that rolls forward as the current month or whatever period is completed. So, for instance, today is the end of August. So, a continuous budget for us, we would be setting up one for September 1 through August 31. And then once we got to the end of September, we would then, our budget year would be October 1 to September 30, and it just continues rolling. Instead of, if we're in August doing a budget that ends on December 31, and then we have to look back and try to plan for the whole next year by itself. Either one is valid. Whichever one works for the company is honestly the best. But a continuous budget keeps managers focused on the future at least 1 year ahead. So now let me bring you to the idea of a master budget. A master budget is a series of separate but interdependent budgets, as depicted by this slide. The sales budget shows the expected sales for the budget period expressed both in dollars and in units, and it's usually based on a company's sales forecast. And something that's really important to know is that all other parts of the master budget are dependent on the sales budget. That's why it's up at the top here. The next is your production budget, which is prepared after you have the sales budget. Okay. It lists the number of units that must be produced during each budget period to meet sales needs and to provide for the desired ending inventory. The production budget, in turn, directly influences the direct materials, direct labor, and manufacturing overhead budgets. Those terms ought to sound awfully familiar at this point. Those are all part of the production process, and part of the planning function of budgeting is to anticipate how much we need to hit a certain production margin budget and then to hit a certain sales goal. Okay. And then there's also the uh, ending inventory budget. So these are all combined together. The ending inventory is how much do we want to have in stock for the next period so that we aren't starting every month from 0 units available for sale. Okay? And the other part that kind of goes with this off to the right hand side of the screen is the selling and administrative budget, which is that other part, if you remember from when we were doing absorption versus variable costing, and we would segregate the selling and administrative costs. So that helps us between the sales budget and everything else, it helps us get to the cash budget. And this is a budget that shows how cash resources will be acquired and used over a specified time period. All operating budgets have an impact on the cash budget. Let me repeat that. All of these budgets affect the cash budget. Keep that in mind. The last step of the process is to go to a budgeted income statement and budgeted balance sheet. Most companies require this. If you have a startup company, these would all then be called pro forma, which means this is what we anticipate, and they would be refined using the control process that we're going to discuss in the next section. So now shifting over to that controlling feature. So we've had all of those budgets. That gives us our detailed plan looking forward. We're now going to look at the concept of variance analysis. And this is a cycle. And note at the very bottom here for the blue slide, prepare the performance report. And this these reports highlight the variances, which are differences between the actual results and what we think should have occurred according to the budget. These variances raise questions such as why did this happen and why is the variance larger or smaller than it was last period. The significant variances and what comprises significant changes from company to company based on perhaps the percentage difference from budget or dollar amount or other factors that are deemed important by management. So we analyze it, we raise the questions, we look for the root causes, and then we take corrective actions to make sure that these, we minimize these variances. And just keep in mind that just because you're under budget doesn't necessarily mean that it's a good variance. It's a variance. That's all it is. We're looking at, okay, this is where we thought we were going to be. This is where we ended up. Why was it different than we anticipated? Okay? Once you've got the corrective actions in place, then we go ahead, do the next period's actions, and the process continues. Okay, characteristics of flexible budgets. Okay, so here we've got all of our budgets and we're making them flexible now. A planning budget, like we saw in that slide a couple steps back, where we had the sales and the cash budget, the direct material, labors, overhead budgets. Those planning budgets are prepared for a single planned level of activity. And the performance evaluation is really difficult when the actual activity level differs from what you planned. It's kind of, yeah, like this slide here. It's like apples and oranges. So suppose you plan to produce 1,000 units, but you produced 750. Well, it's hard to compare results that you anticipated at 1,000 units when what you actually produced was significantly less. In that case, it would be 25% less. So that's why I want to emphasize the idea of understanding flexible budgets as part of the control function here. So, more about characteristics of flexible budgets. These can be prepared for any activity level in the relevant range. And remember, relevant range is the upper and lower limits of what we would expect for activity during a normal cycle. It doesn't consider any extreme highs or lows. That's not considered relevant range. Those are considered outliers. So the flexible budget shows the cost that should have been incurred at the actual level of activity. So at the 750 unit, what costs should have been incurred so that we can actually make the controlling decisions we need to make. It also improves performance evaluation. So we're going to go through an example now to help this make more sense with Larry's Lawn Service. Okay, so Larry's Lawn Service provides lawn care in a planned community where all lawns are approximately the same size. At the end of May, Larry prepared his June budget based on mowing 500 lawns. Since all lawns are similar in size, Larry felt that the number of lawns mowed in a month would be the best way to measure overall activity for his business. And that sounds reasonable, right? That's one way to look at it. Keep in mind the idea, we talked about this a few weeks ago, of the activity driver. Activity-based costing, his activity driver is the number of lawns mowed. Okay. So, here's a static planning budget. Okay. And we have the budget that includes variable costs, the gasoline and supplies and equipment maintenance. Okay, you see those on the lines under expenses. We have 4 fixed costs. We have office and shop utilities, office and shop rent, depreciation and insurance. I know you can argue that utilities can vary. For this example, we're going to keep them as a constant. And we have 1 mixed cost, wages and salaries. Okay, so this is what he's planned based on 500 lawns. But oh my goodness, we actually did 550 lawns. And so our numbers are all based on 550. And when we go back to compare it against the actual budget, we are going to have a slightly different result. So notice the apple and the orange here. The planning budget based on 500 units, actuals based on 550. Well, over in the far right column, you'll see green F's and red U's, which is favorable and unfavorable. It looks like our wages and salaries were unfavorable, meaning they were high. Our gasoline and supplies were also high. Equipment and maintenance, shop utilities were below what we expected. Insurance was high. Total expenses as a result were high. Net operating income was also high, but that was in a good way. And that's, this is where we have to use some flexibility in the budgeting process, because right now these numbers are kind of strange. We need to put them in a frame where it makes more sense. Okay? And so let me just clarify, a favorable variance occurs when the actual revenue is greater than the budgeted revenue. It also is when actual costs are less than budgeted costs. It's kind of intuitive. Unfavorable variances are when actual costs are greater than what you budgeted. Makes sense. So, deficiencies, remember I mentioned that we have four unfavorable variances. So, did we do a bad job controlling the wages and salaries or the gasoline and other pieces that we need? And since the utilities were low and the other variances were favorable, did we do a good job controlling? And the answer is we can't tell. Okay? So we need to think about this because we can't answer the questions using the static budget. So our variable costs should be higher since they are based on activity level, and our activity driver we've decided is the number of lawns mowed. So we need to make some adjustments here. The relevant question is how much of the cost variances are due to higher activity and how much are due to cost control, right? Remember the whole idea of responsibility accounting. We are only holding the manager responsible for the costs over which they have control. So we have to flex the budget to the actual level of the activity. To flex a budget, we need to know that total variable costs change in direct proportion to changes in activity. That's hopefully that is something that you already remember. And then total fixed costs remain unchanged within the relevant range. So within the level of activity, we expect that fixed costs will remain the same. Okay, so how the flexible budget works. Let's go there. Okay, so now if you look in the center column where it has the revenue and cost formulas, we have variable, which is Q, and that's the number of lawns. Since he charges $75 per lawn, we will multiply the revenue of $75 times the number of lawns. So therefore, 75 times 550, 41,250. That's what we expect. Wages and salary, if you notice, they've broken that into their fixed and variable pieces. And gas and supplies, equipment and maintenance are broken into their variable pieces. The rest are all fixed. This gives us an idea of what the operating income should be based on the variable items in the budget. Okay. Oops. I'm going to go here. So, activity variances now. Um, we're going to look at flexible budget, revenues and expenses, and planning budget, revenues and expenses. Any differences between the budget and the actual result is called a variance. Okay. So, compared with the planning budget, we've already seen this, we were way off. Okay. Now, let's go with a flexible budget compared to the planning budget. Activities and revenue increased by 10%, but the net operating income increased by more than 10% because of the presence of fixed costs. Remember that the fixed costs are fixed in total. The more activity you do based on whatever your activity driver, and again in this case it is the number of lawns mowed, the proportion of fixed costs allocated to each product is lower with the higher level of activity. It's kind of like having a pizza, and so the more people that you have sharing the pizza, the smaller slice you're going to get. Same idea. Okay. that was activity variances. Let's go on to revenue and spending variances. Okay, so actual versus flexible budget revenue. The difference is a revenue variance. Actual cost versus flexible budget costs. The difference is a spending variance. So we've got activity variances, revenue variances, and spending variances. Keep those in mind. Okay. Notice we have the little apples. We're no longer dealing apples to orange. We have the flexible budget versus the actual results here. Okay, so now when we look at the revenue, we actually had a favorable variance. We made more in revenue than we expected. The wages and salaries, however, were higher than we expected. Gasoline and supplies were also higher. Equipment maintenance, office and shop utilities were a little lower than anticipated. And we didn't consider shop rent and equipment depreciation in this. And then insurance was higher than we expected, which means now our total expenses were higher than anticipated, and the net operating income was lower. So that's where, this is highlighting, look at all the red U's and the green F's. It's different than what we saw when we compared it to the planning budget. Okay, so now we're going to look at a performance report that combines activity and revenue and spending variances. Okay, so remember we had activity variances and then we had revenue and spending, and we're going to split down these actual results even further now. Okay, so actual results versus flexible budget. We've already seen this. Okay, and then we're going to say flexible budget versus planning budget as far as activity variances. And these are different pieces of the same puzzle. They help us to control as we look at, do we need to adjust our activity in our planning budget for the next cycle? And then from cycle to cycle, how do we plan for the actual revenue and spending? Okay. So if you look at the activity variances, you'll notice that the wages and salaries, 50 lawns are calculated at $30 per lawn. Okay. So this ended up giving us an unfavorable activity variance, and it also led to an unfavorable revenue and spending variance. And that can come from a lot of different things. It could be that you had overtime in there, or maybe you had less experienced people who took longer to mow the lawns, or maybe you had, since we have an unfavorable equipment maintenance, maybe we had a bad mower that needed maintenance and cost labor time. This is where you have to use a lot of critical thought as a manager to say, why did this happen? What are some logical reasons? And then you go back and communicate with your supervisors and try to identify all these different variances. Okay. And then also we look at the flexible budget said we should have made $41,250, but we actually brought in $43,000. Okay, that's great, but why is it different than what we anticipated? And this could be maybe we had somebody ask us to prioritize their lawn, so they paid extra. It could be a lot of different reasons why our actual results would be higher than the flexible budget report. Okay. Now I'm going to shift gears very slightly to a nonprofit organization as far as performance reports. And because they differ from for-profit organizations in one important respect. In a for-profit, we are looking at revenue, number of lawns mowed, whatever your revenue sources are. In a nonprofit, the funding usually comes from sources beside sales. The sales sometimes is in a nonprofit. Universities receive their funding from tuition for the most part, but they also get it from endowment income, from donations, and from state appropriations, especially in the case of a public university. So, universities' revenue may consist of both fixed and variable elements. Okay. Um, so, performance reports. As a manager, you're going to have to tell people how they're performing. These are often prepared for cost centers, which means any division of a company or subsection that generates some sort of cost. These reports should be prepared using the same principles discussed, except for the fact that these reports will not contain revenue or operating income variances. A cost center is assumed to not have any revenue generating function. And an example of that, because this is kind of hard to get to, is an accounting department. An accounting department in a company generally has no sales revenue whatsoever. Their whole job is to manage and analyze and classify transactions and all these things. They don't have a sales component to their normal tasks. So therefore it makes them a cost center, which is, it's neither good nor bad, but it's a cost of doing business essentially. Okay, so well, what if we have multiple cost drivers? So, Larry's lawn, let's say there was some other cost driver besides the number of lawns. Okay, and sometimes we have to look at more than one cost driver so that we can explain all the costs in the organization. The cost formulas used, remember we used Q to denote the number of lawns we were mowing. The cost formulas used to prepare a flexible budget can be adjusted to recognize multiple cost drivers. Okay, so because of the large unfavorable wages and salary spending variance, Larry decided to add another cost driver for wages and salaries. Let's break it down and use another cost driver. The variance is due primarily to the number of hours required for additional edging and trimming. So Larry estimates the additional hours and builds these hours into both his revenue and expense budget formulas. So let's look at his new budget. So now instead of just saying $75 per lawn, we also have to say $75 per lawn plus $30 per hours. Okay? So now you can see in red where we've highlighted that the items have to change to recognize multiple drivers. And this is something to keep in mind. Multiple drivers are common in the industry. So when you're doing performance reports, there's some really basic errors that you have to watch for. And one of them is that all costs are fixed or that all costs are variable. And I think we had this discussion where a lot of costs have mixed fixed and variable elements. So you have to be careful to say, well, just because it's insurance, is it always a fixed cost? Maybe, but perhaps not. So we just have to go through each cost and consider, is it a fixed, is it a variable, is it a mixed? So assuming all costs are fixed, well, we're going to come up with one type of answer. So it's flawed if variable costs exist because the planning budget needs to be flexed to accommodate the actual level of activity. Okay, so this is kind of like that apples and oranges slide. Now, assuming all costs are variable, this is just about as bad as assuming all costs are fixed. When fixed cost exists, the amount of fixed cost in the planning budget should not be flexed. to accommodate the level of flexible activity. This goes back to the whole idea of variable costs vary in direct proportion to the cost driver. Fixed costs stay fixed in total over the relevant range, and it's extremely important when you're doing budgeting to separate variable from fixed costs. So that's it for this week. Have a great week.